Good evening and welcome to another edition of our Inside ProCents educational webinar series. My name is Devin Anderson and I am the president here at ProCents. And I am joined by our co-host, Mr. Garrison Lewis of Retrolux, our new partner and friend here at the ProCents Mansion. And of course, the rest of our leadership team, Mr. J.R. Edens, a ProCents partner, and our very own CEO, Mr. Matt Russell. Garrison, as a guest and as a representative of Leif and the Retrolux solution, would you like to say a few quick words?
Yeah, I appreciate the introduction, Devin. For those of you who may have not heard, my name is Garrison Lewis. I'm one of the senior members over here at Retrolux, typically in charge of support and design with the software. And well, I do see a few familiar faces in here. For those of you who haven't heard of us, we are a lighting audit and proposal tool. We, of course, built to help speed up and make your projects as easy as possible. To give you a little background, we started out in 2012 when our founder, Leif Elgathon, as I'm sure many of you probably have a similar story, but got fed up doing all his audits by paper and pencil, and of course, pulling together a whole bunch of other softwares to do his proposals and calculations. So, of course, with all that frustration, we built out Retrolux to help bring all those pieces together into one software and really just help speed up your projects from start to finish. Even better yet, our entire team is made up of lighting professionals who have been in this industry for quite some time now doing audits and proposals themselves. So it gives us a bit of a unique perspective and connection with the community. It's also helped us work out on thousands of projects and proposals with our community. So that way we make sure everybody's putting their best foot forward. Maybe you've noticed I've kind of mentioned speeding up or reducing time a couple of times, which is probably one of the most exciting reasons why we're just so ecstatic about partnering with ProCents here. We really do believe that everything that you guys are currently offering will just help us increase the efficiency of the software and, of course, just increase the efficiency for our community to help bring projects, to a close even faster and, again, in a more efficient manner. So if anybody has any questions or would like to learn more about us, feel free to reach out to me at Garrison, that's Garrison at Retrolux, RETROLUX.com. Be happy to answer any questions that you may have, but otherwise, yeah, excited to be here. And again, appreciate you, Devin, for bringing us on.
Right on. Thank you very much for that. We are definitely happy to have you guys as a part of our team and proud to be able to introduce you here and see where we can go for both of our individual causes as well as all of those of our members. So thanks for being here, buddy. Matt, would you like to add anything before we get started?
Absolutely. Well, this is going to be a great presentation that really helps people find more value for their projects. And I believe this information will help everyone close more projects when used properly. I've spoken with Randy a couple times, and I know his depth of knowledge will certainly impact you. And as we say here at ProCents, the power of connections will get the job done. And Randy Lucas is the man that will do that for you. So I'm looking forward to this entire presentation and sharing this later with everyone else.
Absolutely, right on. All right, well, today we are featuring, as he mentioned, one of our ProCents sellers within the ProCents environment, ready to wow you with some interesting news and opportunities that you really need to hear. You need the Randy experience. We've had him on before to talk about Section 179D tax incentives and accelerated tax depreciation strategies. This is the guy you definitely want to know and have on your team. Please help me welcome once again, Mr. Randy Lucas of Lucas Tax and Energy Consultants. Good morning, Randy, and welcome to the Inside ProCents educational webinar series.
Hello. Thank you, everybody. It's good to be with you all, back with you again. And those of you who are able to join us live, or those of you who are going to pick this up on a recording, hope you're doing well where you are. We're going to pick up from those of you who were able to watch the last Lucas Tax and Energy webinar. We will pick up a little bit from that webinar, and then we got really exciting news to kind of cover regarding the Inflation Reduction Act and how it will definitely impact your projects, but even go beyond that. And so next slide, Devin. These are just a few highlights, just some background information on me. Just gonna, for the sake of time, I'm gonna keep it moving, and this will be shared with you, and all the presentation. And please, I'm very interested when we get into the meat of the discussion around the Inflation Reduction Act, what questions you're having regarding it, or what are you hearing out in the marketplace. As again, we're all here to kind of learn and understand, and as Matt said, how to incorporate this and utilize this and grow our businesses. So next slide. These few slides are just some of our projects. You can go to the next slide, Matt. Just like, I think there are 3 or 4. We've worked on all types of buildings of all types, and I'm framing this discussion around from the vantage point of people who work in energy management, who work in lighting or HVAC systems controls, who may be doing new construction or renovation. You can keep going, Matt. Next slide. Next slide. That's Charlotte Airport. Based in Charlotte is one of our recent projects with the apartment community, where we were able to utilize the 179D deduction as they were building a new apartment in Georgia. Next slide. Deal with controls and all these commercial lighting products. So next is our agenda. And so basically we're going to do 5 key objectives here. We're going to talk about the Inflation Reduction Act. Second, we're going to do a quick overview of 179D. And that's where we're going to spend the bulk of our time, because I want you to see how 179D was operating pre-enactment and then how it goes post-enactment. And then we're going to discuss another key aspect of the Inflation Reduction Act around renewables and transportation. I want you to know about that. And then some other key incentives or key points. And then we'll close out with some strategies around how do you utilize this new deduction. So next slide. So the Inflation Reduction Act, that's where we start first, our first objective. And we'll get into its impact on 179D, but where we really want to start is kind of give you a fundamental, get you on the porch about what is this Inflation Reduction Act of 2022, what it all means. I still struggle with calling it IRA. I hear people call it IRA 2020 or IRA. I'm a tax accountant. IRA means means something regarding a retirement account, and then if it's not that, and then it takes me back to history and the Irish Republican Army, which somehow makes me detour into U2 and the War album and Sunday. It's a mess. So I'm still working on a nickname for, you probably hear me say Inflation Reduction Act. Next slide. But I think I'm workshopping this, but I'm thinking I watch my fair share of television. I think it's Grady. It's a good companion. I grew up watching Sanford and Son, and Grady was that faithful companion. And that's what I think about the Inflation Reduction Act. It's always going to be something that's by your side, and this is going to be around for about 10 years. Next slide. I'm still working on that Grady thing. I'm not sure about that, but the Inflation Reduction Act, here's 5 quick things. This is really the battery of how this whole thing is coming about. It is law. It was signed into law on August 16th, 2022. So it's almost 2 months old now. The total cost of the legislation, it's a massive piece of legislation, has a lot of different areas of focus. It does some stuff with prescription drugs and seniors and corporate taxes, but the clean energy section accounts for $369 billion. And I have some plus signs beside that, because I've heard some other people talk about that, and actually because there are no caps on these credits and incentives that are available, there could the estimates could go way beyond 369 billion. It could go 500 billion, 600 billion in benefit. Most incentives do start in 2023, and they are available through the next 10 years. Does legislatively sunset in 2033. And then number 4 is all the other tax and rebates, utility rebates, they're still available. So you still have that toolkit that you had before this legislation. This is just adding it and boosting it with this new, incentives. And these incentives are here to significantly grow the U.S. Clean energy consumption, and it impacts all sectors. There is not a sector that I've come across that, from churches to industrial plants to higher ed to residential, it impacts everywhere, and even getting into transportation and environmental cleanup and everything. Next slide. So here's some fundamental things to think about, again, to kind of get these fundamentals. And I'm going to start at the upper left corridor of this graphic. There's a lot here. I'm not going to go through every particular bullet, but you do have some new tools. And one of the things out of there is it allows a direct payment option. And we'll talk about that a little later. But this is new. This is the ability for tax exempt entities to invest in renewables and transportation. And instead of taking the tax credit, they can get a direct payment from the government in the amount of those credits. And there are new credits for the technology that going down kind of counterclockwise. Prevailing wage and apprenticeship. This is a key area, and you'll see this requirement throughout all the incentives throughout the legislation. It's basically just a safeguard to make sure that this work is being done at certain wage requirements and workforce development requirements in terms of apprenticeship. It's not something to be totally it's not a deal breaker, but it does make the difference between whether you take a kind of a basic deduction or you take a higher incentive that's available because you met these prevailing wage and apprenticeship requirements. Counterclockwise, again, it's increasing US-based manufacturing. We're seeing starting to see a lot of media about this, especially in the Southeast. Some auto manufacturers are quickly moving to make their electric vehicles here. Solar is moving operations here. So that is a big part of it because there's some targeted incentives around improving how much we manufacture in the US and how we can create jobs out of this clean energy economy. And then the modified technology focus, that is a fundamental thing because, and prior to the Inflation Reduction Act, we had kind of a list of here are the technologies that will get certain credits. If you don't see those, you're not going to get it. And basically what's happened is what I've called the lesser technologies, like if you work in microgrids or fuel cells, there's some people who are really excited about this because they were only getting like a 10% investment tax credit. Now they're recognized along with solar and small wind to go 30%. And then the tax code is going to shift and basically go zero emissions. It's going to go agnostic on the technology. So as long as your technology, which could be new technology, has zero emissions, it would qualify for the tax credit. And that's very exciting. And then the strategy overall, you got to think, with the Inflation Reduction Act and what's been put into law is something that's very large, well funded. We've got a 10-year runway to work with. And it really does look to advance new technology and advance manufacturing. So I got that bullet point about thinking bigger. I want you to think bigger on your projects because this is a new day. It's if you're thinking about just adding lights to a building, you want to add lights and energy management system and controls. You want to have these conversations. I'll show you the numbers that back that up. Next slide. So we're going to now move into kind of a quick overview of 179D to deal with the energy efficiency, which you did. Section 179D, when I first heard about the Inflation Reduction Act and that they were working on a deal over the summer, I thought this was all about solar, and I didn't realize that it was a comprehensive, holistic approach and looking at energy efficiency. And so energy efficiency, especially in commercial and industrial buildings, is getting a lot of respect. And so there's a lot of modifications here and a lot of work went into it. But let's go to the next slide. So we're going to do a quick poll. I just kind of low tech. I know we could have set up a poll in Zoom, but if those of you are here in the chat, if you could respond A, B, or C to how you kind of operated with 179D in the past, that'll kind of give me a sense of what we're dealing with. I've never utilized 179D on a project. That doesn't have to be lighting; it could be energy efficiency. And then B, I've never utilized. I've utilized it some, but inconsistently on my lighting or energy efficiency projects. Or C, I've utilized it on a majority of my company's lighting projects. A, B, or C. Just add that to the chat. I appreciate that. So we'll go on to that, and we'll come back and take a look at that in a second. Next slide. So the basics of Section 179D, it's been around since 2006. It sometimes is referred to as EPAC or the EPAC deduction because it came out of the Energy Policy Act of 2005. It has been extended periodically throughout the years. And then finally in December 2020, Congress fully made it permanent. So it didn't have a cutoff date, which was great. And it was a one-time deduction. If you could prove that you inserted some energy efficiency into a qualified building, and that building was in the US, you could get it certified and claim a one-time deduction. So it's only a one-time deduction, but it's permanent. So this is all before the Inflation Reduction Act and everything else. Next slide. So the deduction ranges from 63 cents a square foot in 2022. It started out as 60 cents a square foot, but when it was made permanent in 2022, Congress did also indexed it for inflation. So in 2023, the actual partial deduction range, the minimum is 63 cents up to a maximum of $1.88 cents a square foot. If you're in that apartment building complex that I showed you a picture of, that building qualified because it met the level of energy efficiency to qualify for the full $1.88 a square foot, the maximum deduction. But a building could receive a partial deduction. So if you only did a lighting upgrade, you could receive a partial deduction, again, at that 63 cents a square foot. And then the other two areas you could focus on is the mechanical system or the building envelope. And as designed to encourage energy efficiency and reduce operating costs in commercial buildings. The next slide. And this is a list of some of the types of buildings that can qualify. All types of buildings are eligible to participate in this. I should mention that this could be the building owner, or it could be tied to the tenant in a building. So you could lease space, and if you were the tenant and you were leasing it and you upgraded the lights yourself, you could claim this deduction. Next slide. And so there's basically, there were 4 methods to calculate this. As I pointed out, there's the overall building method, which is that's what we use on the apartment. We use the overall, said, okay, is the overall building operating greater than 50% based on the building type? Or we could have looked at the other, so that's one method. The other 3 methods are looking at the interior lighting, and there's 2 methods for doing that. And then there's one for the mechanical system and then one for the building envelope. So there's different ways of looking at this to capture the deduction, but all those other components would only allow you to get 63 cents a square foot. I saw a question about a limit or a cap. Actually, the limit on the deduction is driven by the square footage and the building, the amount of basis. Sometimes we get questions about, is it limited to, it's $100,000 lighting project, but when you do the calculation for the 179D, it's $150,000. It's possible to go over if the building, but you do have to reduce your basis in your building based on the one-time deduction that you take as you're depreciating that building over time. Next slide. And so we use this to check. The way we measure, rather, is that we compare the buildings, lighting. In the case of when we're looking at lighting, and we look at the ASHRAE tables to tell us what is the standard watts per square foot for based on this building type. So if we're in a manufacturing area or we're in a warehouse, or an office, we go in, and you can't see those numbers, but that's the table we go to. We look up the type of building, and then we do our calculations. And I've got an example of our calculations coming up here in a second. Next slide. So the 179D is unique because it does require outside third-party certification. That's what my firm works on. We provide the engineering and expertise to provide the certification. I have an example of that coming up. And it can be claimed in conjunction with other deductions. So a company, a taxpayer, corporate taxpayer can claim the 179D. And then there's a 179 deduction, which is unrelated to this. 179 capital D is about energy efficiency. 179 is an expense election that allows you to write off a certain amount without capitalizing it. And it's gone up every year. I think it's $1,080,000. But this, again, this is something you can claim with your other deductions, but it is not depreciation. It acts like a relative to depreciation, but it's really based on the energy efficiency and the square footage. And again, it was one-time deduction. Okay, next slide. And so I would just want to kind of illustrate how this all works. And this is a project I'm actually finishing up and writing up now. But this is a manufacturing facility in Charlotte, North Carolina. And the owner of the building just upgraded their lights, and they've now gone to these beautiful LED lights. It's very dark in there before, and they use a lot of steel and heavy equipment, and so it's looks great, brighter, and it's more energy efficient, and they're saving on the electricity. They're winning all the way around. Next slide. So this is a screenshot of our calculation worksheet. You can't see that, and we've redacted some of it. But basically, this is a 155,000 square foot facility. We did the math. We compared it to the ASHRAE table and determined that, yes, it did very well when we did our site visit and did the lighting measurements. And we came back, did our calculations, and showed that it was 63% more efficient, which allowed it to qualify for the 67.4%, and able to qualify for the 63 cents a square foot deduction. Next slide. So this is the certification letter, again, redacted, but this is the required statement that our engineer or qualified professional will issue. These are prescribed statements by the IRS that talks about what was determined. And this is really the golden ticket of how you support a 179D deduction. You get this letter, and we include this in our tax report, and they claim this deduction on their tax return. It's only claimed through the tax return. There's no rebate. There's no application like with the utility rebate. This is the way to capture that $97,000 from 155,000 square feet at 63 cents a square foot. Next slide. One other thing about 179D real quick is that it is very unique in the sense that it does allow for the deduction to be claimed by any team or any party that helped design the energy efficiency in a government-owned building. And that's federal, state, local, and all their subdivisions thereof. Under the tax code, this allows a company go in and do a lighting upgrade. My client does this. Okay, thank you. They did the lighting upgrade for this and this high school, and then they were able to claim this deduction on their own tax return because the high school and the school system is not a taxpayer. And that's a key thing to kind of underscore. Now, this was only limited to government-owned buildings. So if this was a private high school or let's say a religious institution, a religious building, religious facility, a nonprofit facility, they could have, upgraded the whole thing, renovated the whole thing, but we would not be able to do a 179D because it's not government owned. Okay, so next slide. If there's more than one designer, it can you can allocate to the designers, and the tax code is kind of silent on how allocation. But if you're working with an architect, and it's possible that you can split this deduction between multiple firms. We can go on to the next slide. It is claimed as another deduction on the tax return. So recap, it's a one-time deduction, and this is pre-enactment because I want you to kind of drill in on this because we're going to go to post-enactment in just a second. So again, it's a one-time deduction. It's good news that they made it permanent in 2020, so it was already permanent, and that's great. And then the range was 63 cents to $1.88. And then there are 4.5 methods to claim the deduction. Government-owned buildings, allocate those to the designers, and got to have the certification. Okay, now we're going to get into what happened. What did the Inflation Reduction Act do to 179D? Next slide. Now, post enactment, here's what happened. They kept 179D as a code section, but they made a lot of modifications. So here's kind of the rundown. Instead of it being a one-time deduction, it is now available every 3 years in the private sector and every 4 year in the tax exempt space. So I'll get to tax exempts in a second, but it is still permanent and and available. Now this new Inflation Reduction Act version is only available for upgrades that occur in 2023 and beyond. So if you're working on something now, that's not something that's available, but it will be available starting in January. And we're in the fourth quarter now, so it's a good time to start having those conversations, have some planning. It is now a whole building focus, and so when we were first looking at things, the whole building had to be 50% to qualify. Now they scaled that back to 25% efficiency, and is now a scale for 25% to 50%. And then the amount of the deduction has gone up from the 63 cents to maximum $1.88. It's now $2.50 to $5 a square foot. That $5 the maximum efficiency, but you do have to look at the entire building. You can't just look at just lighting or just the building envelope. We only now have two methods to claim. I just said it. Building modeling is our primary use, and then there's an alternative use for renovations that utilizes this energy use intensity, which is kind of an Energy Star program, and we basically install the new energy efficiency, and you base it off of the utility bills for the next future 12 months. So that does take a little longer than the building modeling, which does a projection forecast, and this is the actual results without doing the modeling. Now, number 4 is important because now they revised and modified to say tax exempt buildings now can be allocated to the designers. And so the ability for the private school, private universities, religious institutions, now you can look at them as a new market that basically opened up for 179D. Hospitals, any of these entities we weren't able to look at before for this deduction. Now it's available, and again, it must be still certified in the state by a licensed professional in that state's jurisdiction. Next slide. The prevailing wage, that $2.50 to $5, that is assuming that you do meet the prevailing wage and apprenticeship requirements. And if you fail those, it drops down by 20% of that. Well, it really drops down to I believe 50 cents a square foot to $1. So it's 5 times better to be at the prevailing wage. We don't know what the prevailing wage is right now. We don't know what the apprenticeship requirements. We're waiting on that additional guidance. But right now, you are assumed that the project does meet that until that guidance is issued, and then you have 60 days under the legislation to make sure that you're in compliance. But no one's going to check you right now to make sure that you're there. So it's assumed that you're there. There's a special allocation for REITs, which was recognized in the legislation. That was good to see. And number 8 is kind of important for the lighting companies reviewing this. I've been asked, okay, if we can't do a partial and we can't do the watts per square foot, which you just showed us that calculation before, if we just did a lighting retrofit, my engineers are telling me that yes, it is possible that a lighting retrofit alone can move the building efficiency 20 to 30%. And so it is possible that just the lighting alone could do that. But I would say in number 10 or number 9, you are focusing on the whole building. And number 10, think bigger. So you can go in there and you can put in a better light bulb. If you can put in, I've had conversations this week where people have gone back to say, nope, I can get another light bulb in there that's just a few more watts more efficient than what I was planning to put in there. And I'm going to put in energy controls and energy management system, because the more you do, the more you focus on, that is going to get you to that 25% kind of starting point. And then, just only gets better from there. If you can get to 30%, you can get to 35, 40, then, it's all the better. And that's, again, kind of thinking big and then thinking long term, because you've got the ability to come back in here, or the building owner has the ability to think long term about, hey, I can get this deduction every 3 years in the private sector. And then in the nonprofit sector, colleges and universities, they can think, hey, I could relight this great gym auditorium, every 3 years. So this is a really great opportunity. Next slide. So this is a kind of proving it all out and doing the math. And I use that same program, and it was a little more dramatic when I had it all animated out. But I was just starting at the top. So up at the top is kind of the formula for the 179D deduction. Your eligible square footage based on, and then what you qualify based on the applicable dollar value based on the modeling. That's your 179D deduction. And so that for that same project I just showed you, which is that's what they want to do. We'll talk about that in a second. They're doing that for 2022. They upgraded the lights. That was great. 155,000 square feet, and they get $97,000, $97,650 tax deduction. But in that second group, if we said, okay, wait a minute, what if we instead of doing the 20 pre-enactment, let's look at how the same building just with lighting would do. And let's, just hypothetically, let's say we modeled this building 155,000 square feet, and the model shows that we're 30% more efficient because, these great lights are in here. This is now a deduction of 465,000. That again went from 97.6 to 465. And then if they said, okay, what if we went in this new deduction, and instead just lighting, we did lighting and controls, and the model shows now that we're 40%. That again, that same building, lighting, LED lighting and controls, is now showing a deduction of $620,000. And then if they did everything full renovation, that last calculation, and it does go over the it meets the 50%, it goes over, actually, that's great. It's $5 a square foot, 775,000. I mean, I don't have to tell you that, yes, it's going to be a bigger deduction if you go from 63 cents to $5 a square foot, or $1.88 maximum to $5 maximum. But you can see the dramatic difference in these. And this is why, I'm saying think bigger, do more, because this is the power of what 179D can do. And this is really basically this deduction saying, or the theory of change is, we know these renovations cost money. We want to help partner with you to make this building more energy efficient. And it is going to be more energy efficient. And here's, we want you to do everything you can to make this building more energy efficient. So this, again, this is kind of a great illustration. You want to take a screenshot of that, or those of you watching, pause. How can it be $5 if the cap is $1.08? The $5 is under the new Inflation Reduction Act. The $1.88 is the old law. So that is for any project done before the Inflation Reduction Act or was claimed in 2022. And I'll just say, my client, we did talk to them about this and say, hey, we just learned we got this new legislation. We don't have all the information, but we think we qualify. Do you want to put this off until 2023? And basically they said, no, we want to go ahead and claim it. Good to know, but we've got some other sites and other facilities, and we got this budgeted in our CapEx budget. We got to spend the money in 2022. So it's a little weird transition that we're in between 2022 and 2023. But you do have a right as a taxpayer to kind of choose how you're going to navigate this between 2022 and 23. Usually it's something where the tax deduction is going away and everybody's scrambling to get everything done by the end of the year before the incentive goes away. We've got options now because there's a bigger incentive waiting for us on the other side of next year. Next slide. So I've gone through the 179D, the impact from the Inflation Reduction Act. I just want to highlight some other areas here. I want to look at renewable energy, and I want to look at transportation / electric vehicles. Next slide. So we'll start with renewable energy first. I bring this up because you're going to see this everywhere. The investment tax credits, which is basically a dollar for dollar reduction of tax liability for making these investments in renewable energy. All the investments, all the renewable energy technologies went back to 30%. They actually started this year at 26%. They were scheduled to go down to 22%, but they're now back at 30%. And so if you invest $100,000 in solar, you would receive a deduction or a tax credit of $30,000. You invest $1 million, you're going to get 300,000. So there's a 30% investment tax credit for the next 10 years. It's, again, this runway is amazing. We've had these 2-year runways or the step down, after 2 years, but you got 10 years now, and this is both on the commercial side and the residential tax credits. And then number 3 is really important. Nonprofits, state munis, tribal nations can elect to receive direct payments because they're not taxpayers. There's this direct payment option that's available to them. So a nonprofit, a university, a school, state government could invest in solar or energy storage or any of the other renewables, and they can receive a tax credit direct paid back to them. That could be part of the deal and part of the financing. It's exciting. Prior to that, we weren't able to do this because they weren't taxpayers. We didn't have the tools or didn't have the ability to do anything with this. And then number 4, businesses can use these tax credits. They're basically able to transfer those credits to an unrelated third party. You can only do this one time. You don't have to transfer everything, but it is possible to transfer the tax credit to an unrelated party, perhaps the vendor or the financing. And again, we're waiting on some additional details in number 5. We're waiting on some additional details on how that, but essentially for businesses, the tax credit can be transferred, and that essentially means that it's refundable. And so even if you have a loss, again, there's no business that can't take advantage of this. So if you have a loss and you can't use the tax credits, that's usually what we hear. Actually, those credits are now refundable, and you can monetize them basically and transfer them, use them like cash to pay an unrelated party. It's incredible. Next slide. So that was the renewables. I wanted to focus on electric vehicles because there's huge incentives in the Inflation Reduction Act regarding transportation. So number 1, there's a new, they modified the clean vehicle credit, $7,500 for a new vehicle, $4,500 for used. That's a new credit. It's you can sell a used, or if you're if the car is not, and all these electric vehicles are going to be registered based on their VIN numbers and everything, and then they're able to track. And so if you buy it used, you can get a $4,500 tax credit. There are some limitations on that. That Audi hybrid that you saw in the picture of, that hit the limit. It's an $80,000 limit on the vehicle. So not every vehicle, and not every vehicles have to be majority of, or not, well, it's gonna be a scale of how much it has to have manufactured in the U.S. And so you're starting to see a lot of news reports about companies trying to move their processes to the U.S. because they don't want their vehicles not to qualify. And there's some vehicles that don't qualify because of their requirements of how much is produced or manufactured in the U.S. And there are some limitations. But with number 1, with the more electric vehicles, and research shows that consumers are more likely to buy electric vehicles, if there are tax credits associated with them, then that means number two, there's going to be a need for more electric vehicle infrastructure and charging stations, which is something you can install, and you can get a 30% tax credit on the charging station, or basically called an alternative fuel station, 30% up to $100,000. Number three, you're able to utilize the tax credits for commercial fleet. So even in your own business, if you were trying to convert, you got some delivery trucks and pickup trucks under a certain weight. Depending on the weight, you can get different tax credits available. And then number four is that they actually open that door to allow anything that's electric powered. So carts or forklifts, if you got that, say, in a manufacturing facility that's using electric power, they could potentially qualify for these fleet credits. And again, we're waiting on some additional guidance on that, but this is something to be very aware of, because even if you're not dealing with this directly, if you're just working in buildings, those commercial buildings, those apartment buildings, multifamily buildings, likely colleges and universities, they're all going to be, this need for EV infrastructure is going to be huge. Next slide. So we're going to go into fourth objective, just some other key incentives. So there's, I think it's 775 pages of legislation, probably 550 devoted to clean energy. So I just picked out scooped up some of the highlights. This is this isn't even scraping the surface of everything that's available. Next slide. But I did want to give you some ideas of what's out there. Advanced manufacturing, go through this quickly. Advanced manufacturing credit, that is something that's available. You're starting to build these components here. They brought that back. It was something that was funded. It ran out of funding, but they brought it back with another $10 billion. And once that $10 billion is gone, that will dry up again until they reauthorize that. Production tax credit, that's basically where you can, instead of that 30% upfront for the investment, you can get a credit based on how much your renewable energy produces. And so that's available, and that now includes solar operations. If you're thinking about getting into carbon sequestration, and a call earlier today with an environmental company, and they're processing a lot of stuff to keep it out of the environment and saving carbon, and they may be sitting on 6 figures in tax credits from what they've been able to process, and they're looking to do more. Residential credits. Number 5 is really interesting. I talked about this on my last presentation. The USDA Rural Energy for America, the REAP grant. It's a grant that's available for renewables and energy efficiency in qualified rural areas. But the grant got increased in the legislation from 25% to 50%. And so that's a significant, we're waiting on some additional guidance from the USDA, but that's not only available for just agriculture. You can be a small business. And if you got projects, I've got a warehouse I'm working on in rural Virginia. We're filing for a REAP grant, and I've got another one in South Carolina. We're about to file, and we were going to file 25%. Now we're revising and filing at 50% of the cost of the project. And then there's number 5. There's various grants, and just be on the lookout. There's this new green energy green bank that received $40 billion of funding to make low interest loans to finance some of these projects, to kind of help spur the capital for these projects. And then there are a bunch of environmental and justice block grants that are available, and they're going to be distributed to the states. So keep an eye out for those. Next slide. We're doing pretty good on time. I'm going to kind of wrap up here. Implementation strategies, next slide. And some of this we've already talked about a little bit. Again, not all incentives are available. You can, again, calls, should I wait and, not contract until 2023? Yes, you should go ahead and pursue just as you're doing before. But you can contract in 2022 and complete the project in 2023. And then number 5, the other incentives are available. Utilities, the states starting to see a little bit of reaction. California made an announcement about electric vehicles, and they've already had a lot of standards. But a lot of utilities haven't reacted to this. There's going to be some changes in the codes and the statutes, and so something to definitely be on the lookout. Next slide. So I do want to kind of go through, Devin, are there, I'm looking at the chat now, are there questions that need to kind of cover, or anyone
I
else
think
have any questions?
I think most of them actually got answered along the way.
Great.
There was one question up here from Art Trainer. He goes, apropos of your earlier comments, this means IRA sunsets in 10 years. I think you answered him.
Yeah.
If anybody want see there's largely credits, no deductions, and I think you responded.
Yeah, so let me I'll underscore that. So 179D that we talked about with the energy efficiency, that is a deduction. But everything else, and item 3 and item 4, most of that's credits. So those are tax credits, for the renewables, for solar, or energy storage. And then transportation, those are credits as well. So credits are dollar for dollar reductions. Deductions work to calculate your tax liability, so that's kind of above the line before your taxes are calculated, and they are as effective as your effective tax rate. So that that 155,000 at $5 a square foot, that deduction, and then you would factor in the effective tax rate, on that amount. So that 775,000 is basically a deduction, which then the cash value, the after-tax value, is based on the tax credit. So I think that sounds
pretty
good.
much all of it. I think
yeah.
most of it got to one of the questions I had, and I don't know if you actually answered it or not.
Sure.
Was you had mentioned that this starts in 2023. So at what point does it become eligible in 2023? Does the project have to actually physically begin after 2022? Or can you start a project now and have it deploy in 2023 for it to qualify?
Yeah, you could start the project in 2022 if we're talking energy efficiency, and definitely if we're talking renewables, you could start the project in 2022 and finish it in 2023. What we don't know, and what's interesting, I heard somebody talk about this on another webinar. I think it's kind of important to that for the direct payment that happens. Say, you've got I've got this example where I've got a school system in South Carolina, and they're looking at buying electric buses, and they're going to, they're excited about this. They're pumped up. They're going to do this. I think they're about, try to budget to buy 20 buses. It's going to be great. Well, yes, they're going to get 30% tax credit on those buses. They're going to do some charging stations, but all of that has to be completed. And we don't know all the inner workings of the direct payment, but we believe that some way, somehow, they've got to show that they did complete the transaction, that they did acquire those 20 buses. So there's also going to be a need for, a Ross Rita or, some financing partners to come in, maybe that Green Energy Bank, to do some short-term financing until all that works out. But my advice would be, yes, try to start the project as soon as possible. But we are waiting on some additional guidance on how things like that direct pay will work, the apprenticeship and prevailing wage. We got to get some guidance on that. So there are some unknowns out there, but there also may be some gaps where we got to finish these projects before we're able to do it. But again, we got these some new goodies and some new incentives and new tools to encourage that investment.
Sure. All right. Well, that's all that's in the chat. Does anybody have any further questions they'd like to ask directly to Randy? I think it's dinner time.
Yeah, it is. And got baseball playoffs, so much going on in the world.
Absolutely.
You're going to see my contact info. Definitely follow up with me. To reach me through the ProCents network or Slack. I'm available. And then again, I will leave my contact info. But let's go to the next slide. Just kind of close up with some closing thoughts.
I did have one quick
Taylor.
question.
Oh yeah, please.
Sorry.
Yeah. No, go ahead.
How do you qualify to, I guess, survey a building to see if it qualifies for the tax incentives? Is that like a certification you have to?
Yeah, there's a prescribed modeling, and if we're talking energy efficiency, there is a prescribed modeling that happens. There's actually prescribed approved software that the IRS will accept. Most popular will be Trace, which is, I believe, is made by Train or Ingersoll Rand, and then basically we're taking the building components and we're basically putting in the model. But when we go, a part of it is also going on site, and we will have to verify, if we say we've got 208 lighting fixtures, we need to go in and verify, yes, there are 208 lighting fixtures. And so our process when we're looking at things, we do like to look at the blueprints first, because my engineers, they will typically work to make an assessment. If they see something that really bothers them, or the R values with the drawings and the blueprints, that will probably, they'll raise their hand and say, we're not confident that this will do very well in the modeling. When we were working on that apartment complex, they did some diagnostics up front. And so that's kind of our process. We will do the diagnostic. If we don't see anything that's really going to bother us, then we'll proceed with entering the data in the software, see how those calculations work out. And then if we need some more information, or we may need to look at some more drawings, we'll do that. Or we will proceed with that, and then we have to do the site visit to kind of basically do a verification that everything is in place and it's operating in order in the taxpayer's business. So good question. So there's some final thoughts here. Again, kind of stay alert. This is new. It's just, it's not even 2 months old, but everybody's, talking about this. They're trying to see, but we really haven't seen how a lot of the major players are reacting. I saw in our interesting article this morning about some of the overseas governments are not really happy about this manufacturing. I think some of the car makers overseas are not too keen about the fact that they can't make their cars outside the U.S. and then just bring them in. They got to do this to compete in this market. But this is what incentives will change behavior. So this is stay alert to these changes that are coming. I think stay creative and positive. There's some endless opportunities abound. There's a lot going on, but I definitely see a lot of positives here. And then number three, I've had some conversations with some companies. I've got some lighting companies that are now looking at EV infrastructure. I've got some solar companies now looking at getting into environmental cleanup and labor workforce development. there's just some really interesting things. You could do some charging stations, develop some new revenue streams. But yeah, there's some new opportunities opening up, and just even new markets, with the used EVs, being able to look at hospitals now under these deductions. And then I'm a big component of the number 4, that sustainability. Companies use it right, it can be a competitive advantage, and all the tools are there to do that. And again, number 5 is and I do think bigger is something one of my colleagues kind of shared with me. I didn't come up with that originally, but I think this does say it all. Really, no entity can't utilize something in this. Even if you don't do anything with your building, but you got delivery trucks, then look to electrify your vehicles or your fleet. You don't have to put solar on, but there's some other things you can be doing. So again, there's no excuses to not take advantage of these incentives, and we do. It's well funded. It's going to be around for 10 years. So this is kind of real deal. Next slide. This is my contact info. If you want to take a screenshot of that, or those of you listening on recording, pause it and take a screenshot. But this is how to reach me via phone or email. And we definitely want to discuss your projects further as ways we can support and help. If you need that some consultation on where to start or what to look at, we're doing some coaching and advising on this. And then also, if you doing specific projects, we can definitely help out with those as well, and help you with those incentives. So that's all for me. I want to thank you all for your time. We're a little over, but Devin, Matt, everybody, just thank you all for this opportunity.
Right on. The only thing missing from this slide, Randy, is the bat signal. So I think you pop that thing in there, then they'll actually get a real feel for who is Batman.
Yeah.
All right, guys. Well, Randy, thank you so much. This concludes today's Inside ProCents educational webinar, hosted by Mr. Randy Lucas of Lucas Tax and Energy Consultants. Thank you again, Randy, for your time and for this informational and professional presentation. If any of you would like to ask any other questions of Randy, and I absolutely recommend that you do, or wish to dig into a project opportunity, the information is right here. I definitely recommend reaching out and having that conversation. So thank all of you for spending your time with us today and for supporting our ProCents environment. Winning is a team effort, and we are here at ProCents are all proud to be working with each one of you. With that, let us remind you that there is a better way to buy and sell, and it begins with a community that you can trust. At ProCents, we make connections that are sticky and that last. Then we get out of the way. We never stand in between you and your new connection. We simply open the doors and let our members choose their own path together. If you'd like to know more about ProCents, check out our website at www.procents.com or reach out to one of our leadership team members and get on our calendars. There is no better time than now to get on this train. Thank you all once again. Have a spectacular day.
Thank you, everyone. Thank you, Randy.